तो आज का प्रोग्राम इंशाल्लाह I'm very very sure we're going to really like it because I think let's start so that yeah, okay, all right. So most businesses think they have a cash problem. In reality, they have a structure problem. Hello and welcome back to Insights with me, Farzana Muhammad, Uncut Conversations that Matter. If you have been following this series, you'll know we are building this conversation one pillar at a time. In our previous episode, we spoke about business continuity and why it is not a document but a capability. If you haven't watched that yet, I would strongly encourage you to go back because today's conversation builds directly on that foundation. Today, we move into the second pillar, financial resilience. And this is the one that truly determines survivability when everything else starts to fail. Because in today's environment, interest rates are rising, credit access is tightening across the GCC, global trade is being reshaped by tariff volatility. And what we are seeing in this, businesses are not struggling because of weak products. They are struggling because their structures were built for growth and not for stability under pressure. So the question becomes, have we actually built our businesses to withstand a slowdown? To help us unpack this, I'm joined again by Sarma, who works closely with CEOs and leadership teams to help them move beyond managing numbers and instead build financial strength and resilience in their organization. Sharma, welcome again. It's great to have you back.
Thank you. It's my pleasure again.
Oh, and this is going to be a very, very interesting topic, I'm assuming. So,
I'm
so let's start with the environment we are operating in today. The global tariff landscape is shifting quite rapidly. What does that actually mean for UAE businesses that depends on the imports, components, or distribution? Please let me have a insight on that.
Thank you. So today's global economy, if you see, is evolving into a more holistic, globalistic economy in terms of whether the taxations, for example, there are minimum corporate tax, which globally all countries, one after the other, are signing off. That is, you have to pay a minimum 15%, even if you are in a zone like in UAE. The tax systems have to be standardized across. Your tariff systems, if you see, a lot of these CPAs are being signed off. Economical agreements between countries and continents and associations are being signed to make it uniform and effective. So these is very much evolving, very much to an extent making the world a better, more effective global village. But at the same time, the strengths of each region would remain. The interactions, the policies, the politics of the entire scene also plays a role in which strengthens UAE, especially in the GCC, to have, because it's one of the neutral countries which has partnerships and associations with almost everybody else.
Correct.
So that helps this nation to ensure that its strength in terms of whether it is trade, whether it is the supplies, or being that financial hub in this region, it still would continue and it would rather facilitate more effectively than it used to be till now. But the current turmoil is exposing a lot of fixtures. The war is making things much more expensive, logistically challenging, being a little more landlocked than some of the other countries. When this fight has taken up, reaching UAE ports are a little more difficult than some of the neighboring countries. So it is bringing in certain challenges. and increasing the cost for that matter more than some of those other countries. But if I think the rulers have taken the right direction in terms of facilitating, green channels. For example, between the Oman port and Dubai, there is a green channel which has come in, which is ensuring that the tariffs are minimized. The additional burden of transportation is there, but in terms of customs or any other such taxes, because of using the Oman port, is minimized.
Minimized. Okay. Okay.
So these things are going to definitely help and continue to ensure that UAE has that strategic presence. It's about organizations to be a little more flexible in the way they operate and flexible the way they manage these situations. That's all.
Very well said. Okay. So, we let's get into more tactical value question. We often hear business owners, we are profitable, we are fine. And so, what is the difference between a business that has cash flow and one that has true financial resilience? Because when you just spoke about today's scenario, how is that scenario you can put into this particular question? How would you respond to that?
Excellent. Actually, that is something which is very important because most of the organizations believe, like, a very good cash flow is equal to a very good financial resilience, or even cash reserves for that matter. So these are actually cash flow or cash reserve is just one element of a financial resilience. It's not the total element. So cash flow is like, can I survive the next, let's say, 30, 60, 90 days without an additional income? That's all it can talk about. A financial resilience is about how severe is that impact going to be, apart from can I survive that? And am I ready to come out with more and further options to overcome these current situations, and how fast can I do? So financial resilience is much more. So it has to talk about, let's say, the depth, the number of days of survival. It talks about the flexibility of the kind of commitments that I have, the payments that I have to make and all, and the credit architecture, which is basically what kind of credit facilities do I have to prolong that survival.
Okay.
Without an income. So true financial resilience, in our organization, Career Tree, what we talk about is 6 elements or 6 pillars. One is the liquidity buffer, how good it is, which is the cash flow. The diversified revenues, are we depending on a couple of customers more than others? Third, do we have a cost structure which is flexible? So the cost base, how much percentage of your fixed cost that you incur every month is fixed,
Right.
and how much of it is variable?
Okay.
Fourth is your pre-arranged credit facilities. Most often the organizations do the mistake of getting these credit facilities at the time of crisis, which is not when it works. Most of the banks or financial institutions would not want to provide at that point of time. But when you're doing really good, they would provide you a better offer, better rates. All you have to do is avail it, not use it. Then fifth, you have the receivables management. How effective is your receivables? How active they are and how efficient they are. Then sixth is your having your right insurance or hedging protections that you have to take to ensure that your survival is more effective and stronger compared to other organizations. So these are the 6 pillars that would ensure that the organization is effective and is financially resilient during the time of crisis. So as I said, therefore cash flow is just where you are for now. Are you able to survive the next few days? Whereas financial resilience talks about the entire road and the journey and how far and how effective would that be.
I think this kind of mind shift is needed looking at the scenario today for many businesses.
Definitely.
Yeah, so I think that's very well explained. Okay, let me ask this from a very different angle. If revenue slows down for the next, say, 60, 90 days, What typically breaks first in a business?
That's an excellent question. Usually, people assume that it's probably the profits which go down, or the probably the revenues which go down, but it is the leadership and leadership's fiscal discipline
Mm-mm.
is what typically breaks down. So, what I mean by this, so in a crisis of first thing is your receivables slow down.
Mm.
You don't get in the payments, your inventory or stock gets piled up because of a lack of sales or slower sales, which means the cash is getting tied up. Your supplier pressures most often increase during this time because everybody wants to get that first buck. Then your anxiety among the people in the environment, everything goes up,
Mm-mm.
and all this leads to decision paralysis in terms of like, whom do I pay, whom do I not pay, whether I pay the employees, whether I pay the suppliers, the creditors. All these are questions which get immediately knocked onto, and that's where the problems and challenges start and the leadership paralysis initiates. So in practical terms, it is not about the business actually running out of cash, but the assumption that the business will run out of cash and therefore hitting the paralysis
Right.
is what it works. And that's why at Career Tree we say, like, don't look at these things. We recommend a 13-week cash flow rolling cycle analysis, which in normal sense we you can look at every 13 week on a weekly basis, but during a crisis probably you can look at it daily, where we are looking at the cash risk, what are the revenue risks that we have, what is the, are there anything which is leading into bad debt, what are the backlog in terms of cash recoveries, claims, and all those things. And then these are the things that we focus on,
That's
and
good.
how do you overcome specific action plans that you overcome. So these are the things that we recommend.
Mm-hmm.
And yeah, of course, then depending on each sector, what next specifically where the challenges work is going to be different. Like for example, manufacturing, probably the raw material would be an issue,
Mm-mm.
availability of raw materials. For logistics, maybe the utilization, the fuel cost, like the container cost if you are an export import. The depending on sector, those are the specific things that impact. But overall, it is this decision paralysis
Mm.
because of the leadership breakdown or the working capital decision breakdown, which the business gets impacted first.
Right. So I'm just wondering, do most leaders actually know the answer to this before it happens? Do they do that?
that's that's an important question, and that's where what we spoke in the last episode of business continuity plan. So any organizations that have a working business continuity plan, the leaderships would not get into this paralysis.
Yeah.
Organizations which do not have, because they have not anticipated, they have not gone through a simulation of these challenges, they
Mm-mm.
would have this paralysis.
Yes, so true. Okay, so let's move on. Um, so let's say the pressure is building. First reaction you just mentioned that we see is cost cutting, especially the human resources or the headcounts. But before businesses take those steps, what are the key levers they should be looking at first? I mean, we understand the scenario, and I've been hearing a lot of people losing their jobs in today's
Yeah.
scenario. But what were those, key things they could have done before, getting rid of their good?
Yeah. I think that's a very important question, and most often, like these headcount reductions, as you said, or cost reductions, are the first things which everybody wants to get into.
Hmm.
Yes, cost optimization is important. Yes, taking the right decisions in how to utilize your cash or your working capital is important, which is what I've spoken just now.
Hmm.
But is the headcount the first thing that you have to work on? I do not believe so.
No.
Headcount, if you look at a headcount, the problem or the challenges which come, if you go with this method, once the crisis gets resolved, is much higher.
Yes.
The organization brand image and all gets impacted. You don't get your talented workforce. So these are the kind of, so what I would suggest normally is there are the few steps that you have to first look at before you get into that context of a headcount. So
Okay.
first, where is your cash get released? Where is it stuck? The
Oh,
inflows.
that's a good one.
So can I collect those faster? Can
Mm.
I look at invoicing faster? Complete the work in progress as quick as possible and invoice it to the customer so that there is that revenue cycle kicking in. Is
Mm.
there any early of like early payment offer, so against a credit rate cycle of 90 days or 45 days or 30 days, can I ask have a conversation with my customer of providing, especially those top customers where the major amount is stuck, can
Mm.
I give them some early discounting to get cash flow back faster?
Okay.
That's your first step. How can I get in the inflows faster?
Mm.
Second is outflows. Can I rework on the timings of the outflows? Negotiate your supplier terms. Can I increase that 30 to 45 days, that 45 to 60 days? Or can I defer those non-critical spends?
Mm.
Can I delay those, capex budgets or those shipments by a few more days? Can
Mm.
I, optimize the subscriptions that I have? The various subscriptions that the organization has. Can I delay or defer those subscriptions? Can I look at what are those discretionary spends that I'm having every month? Can I reduce or delay or defer them? you
Mm.
know
Mm.
that's the second thing.
That's it.
Then third is your working capital drag. So the stocks that I have,
Mm.
that working capital work in progress that I have, that SKUs, the complicated SKUs that I have, can I do something about it to release that working capital and convert it into cash faster? you know is there any, like, if I was trying to work for an SKU which is one off, can I quickly convert it into something which converts faster and into an SKU that I can quickly sell
Okay.
in this current market? Those kind of things I have to look at.
Mm.
Fourth is, from the beginning, try and work on a flexible cost structure, which is what I was also talking to you before. So what I mean there is, can I have, let's say, even if it is from a headcount perspective, can I have lesser fixed employees and more on the contractor outsourcing method, especially those non-skilled areas? Can I convert them into outsourced manpower or a contract workforce? Can I have those non-critical areas
Mm.
having the flexible staffing in mind? Instead of having 10, 15 trucks and drivers, can I have a contractor who would handle my fleet?
Mm. Mm.
And therefore I can have these resources as and when I require. There are organizations today which I'm seeing, they have to they don't know what to do with their vehicles, because against 10 vehicles there are only 3 vehicles that you are using, and there is that cost is there incurring. These things can be avoided. Then finally, using your financial tools intelligently, like, for example, as I said, you're having those credit facilities in place before in hand. So these are the things that you have to work on before you get into an actual workforce or a headcount reduction.
Oh, very well explained. And I was just when you were talking, I was thinking about one company. It's a wellness company, had 5 or 6 branches here. Once this issue started, he closed all of them. This shows me that person did not know exactly where he was heading, because if he was listening to something what you're just telling me and my audience, he would have been able to save a lot rather than
Definitely.
closing down all his wellness. I mean, he closed down all his wellness centers here in Dubai. It was a
Yeah.
big surprise for me. But
In
okay,
fact, if you see, this is very common actually in the small or
in small,
SMEs.
yeah, yeah,
Yeah,
I
but
see that a lot.
even during COVID, I've seen some of them. They have gone back to their, like, for example, what are the costs? One is employees, one is the rentals, which is the major, which is for him.
Mm.
When he is closing down, he will any which ways have to forfeit the advances and the minimum commitment times which he has
Oh,
given to the owner.
mm,
Rather, converse with the donor. Can he have a deferred payment schedules? Can he have a reduced payment cycles, So most owners at this point of time, they also understand their practical challenges. They might come forward to support you with that deferred payments. So
Exactly. Yeah.
rather than looking at a knee-jerk reaction of closing things down, look at those options, and that all depends on the relationship that you built with them
Mm,
when things were going strong.
well said. Okay. Um, there are principles often discussed. You just also mentioned, build your credit facility before you need it. Why do so many businesses still wait until they are under pressure to secure funding? What is the reason that they avoid doing that?
So there are a couple of things. Most often it is about the psychology of the entire process. So people believe like once you have a credit facility, you have to use it,
Use
which
it.
is not mandatory.
Ah, good to know.
Second, uh, credit facility they don't want to have. There is a psychological thought in some people that I don't want to have any loans taken,
I've heard that.
but it credit facility is not a loan. It is
Hmm.
an option for you to utilize during your time of difficulties or handling your working capital better rather than taking a knee jerk reaction. This is what is going to help you
Makes
in
sense.
those times of crisis. And crisis need not be an environmental crisis. It could be that one of your top clients who was supposed to pay you, they had certain business challenge or restructuring or something they have undergone, or a merger and acquisition has happened, and therefore the payments are delayed. I've come across some organizations which which went into bankruptcy only because their major, customer, who was more than 50% of their cycle, they had upgraded their ERP and that ERP was not working and they couldn't pay.
Okay.
And this impacted the SME significantly. So these challenges you can easily overcome when you have a credit facility. And
Mm-mm.
again, I'm telling most people assume that it is that you have to utilize it. It is not necessary that you have to utilize it.
This is a very important thing. I think the what you just mentioned to both the reasonings. That's what some people come up with those ideas that this is going to put me under a lot of pressure if I utilize the credit. That's what a couple of people I know. I was chatting about this,
Yeah,
and they say, "Oh no, we are not going to use any credit limits. Otherwise, if we are unable to, pay and whatnot, we will be paying more because I mean." The way people think, sometimes
sure.
it's very important that they need to be educated, and I think that's what we are trying to do right now. Okay, let's talk about a little bit about preparedness. What does a real financial stress test look like for mid-size UAE businesses? We are talking about business people who are in UAE, and how often should it actually be done? That stress test.
Okay. That's a very important question. Most often, these stress tests, what people do are tabletop exercises. They do it probably when an auditor asks for
We talked about
as
it.
part of some certification or a statutory regulatory initiative, or when there is a crisis,
Hmm.
which is actually not effective.
Yeah.
That is when you get into problems and challenges.
Mm-mm.
So, what you have to do in terms of a stress test is whenever there is at least once in a quarter,
Mm-hmm.
or whenever there is a change, like for example, some key leadership position, risk position, there has been a change. The
Mm.
person has left, or you have promoted him, and some new person has taken over.
Mm-hmm.
Such kind of scenarios also you have to look at when there are changes in terms of when you have realized that your organization has changed in terms of the income generation. You are depending on top three or top five of your customers now. Their percentage has increased in your total income.
Mm.
That is an important journey when you have to take. So there are different scenarios during which you will have to do these tests, financial stress tests, and definitely one when your revenue is being tied up to certain few key people, or in fact, even for the purchases that you have, you are dependent on a few suppliers. three or four suppliers for majority of your raw materials. Those are the companies which should definitely do it minimum on a quarterly basis to ensure that they are still resilient. They can be resilient even if one of them fails. So how do you do this? Coming to that particular question which you asked, I would suggest that one, you have to do these scenarios in terms of not a tabletop exercise, but actually go through. Let's not take these raw materials from this particular supplier. Let's see who is the alternate. Build that. In the next 30 days, I have to find out an alternate supplier. I have to ensure that the quality meets, and I work on it without using the first supplier. So second month, I don't use any. So am I able to? What are the challenges? You do these real time scenarios. Keep the people aware. Keep it posted. Look at, if I don't get any input, assume that there is a supplier whom you're there is a client whom you're really dependent on. Shift that entire business that revenue into a separate account and assume you don't have that account. Now how are you able to manage it for 30 to 60 days? Create these real time scenarios for, as I said, like one for your input, the customers and client revenues, for two for your suppliers, and three for your key departures, key risk profiles. Now assume that this person was on leave, send him off on leave. Anyway, you have to give those annual leaves for them to go back to their native country. So use that to stress test yourself. Like if they are not there, where am I getting challenged? Without, I mean, most often when these senior leaders go back for on their vacations, they're still half the time on their calls.
Yes.
They still attend those meetings. So can I avoid it completely? Can I give them the free time? So the leader has that real holiday. And the organization is stress testing using this, and then see, why did I have to contact this person back? What are those scenarios? And then create risk analysis for that and come out with alternate action plans, so that next time when the person goes on holiday, it is really a holiday for the individual. So these are the things that I recommend for you to do.
Nice. But do you see companies doing that? Because all I can hear everywhere is, if like you just mentioned, if a leader is out of the country, he is still constantly chatting and giving responses, because the scenario which now it has been created in such a way that that person is so important that we cannot do without. Does it tell me that the companies are still not strategizing? Because
absolutely, you're right.
I'm hearing this from everywhere. Any company we talk about, and when the family is going away, the husbands are still busy chatting. So this looks like what we are talking today is, it's actually very important, and I think the leaders need to also give the space to their subordinates or their colleagues and trust them as well. Do you think it's a trust issue in this sometimes?
Yeah. So one is on the trust issue to an extent, yes. There are multiple factors actually. There is also the issue of, in certain cases, some people believe others are not as good as me.
Yes.
So then in some people, it is about warming the seat. What happens if everybody else can start doing in my absence? Then my seat is in a risk. That's something which people are always afraid of. So there are multiple reasons why this happened, and coming from a very specific business context, it is that the people really do not look at that as something which they need to work on, because these business resiliences, these leadership non-availabilities, people assume they don't happen. That's like these are a very rare case, once in a lifetime kind of a context, and therefore they believe like they don't have to work on it. But in today's world, it is no longer a once in a lifetime. We've already seen in less than a decade a couple of major crises.
Big crisis, yes, and still we when we are chatting here, we are still talking about how those crises should have been taken in seriousness and built on to those, business continuity plans and whatnot. But I hope, that our audience are understanding the importance of what we are talking today. Uh,
True.
yeah. So let's talk about, and I would say this would be my last question to you for this particular episode.
Sure.
Uh, Businesses that is performing well today, what should they be doing right now that most are not, to build a resilience before the next disruption? And we talked a little bit just now, but if you can actually uh, talk a little bit further than what we just had
Sure.
a chat.
Sure. So when an organization is doing good, is the right and the only time when they really have to work on building a business continuity plan or a resilience plan.
Mm.
So as I mentioned previously, but talking specifically from the context of financial resilience,
Mm-hmm.
the first thing that you have to do is credit facilities. Get your credit facilities in place. Negotiate with your banks for the overdraft facility, for a working capital line, for a revolving credit facilities. When your income is strong, you will have better rates that you get. You will have a higher credit facilities that you get.
Okay.
So that's the time when you have to establish it. And again, as I said, you don't have to worry about using it because none of them have to be utilized always in 100%.
Okay.
You use it 5 or 10 or 15, doesn't matter. No bank is going to come and catch hold of you for not utilizing it. Right? So that's the first and the foremost thing that you have to do. And also remember that when you are in stress, banks can understand that you are in stress and they would ensure that they make themselves more secure by giving you less, by
Mm.
increasing the interest rate. By they try to ensure that the bank is always safe.
Right.
So
100%.
ensure that you get it in the time. Second thing, build your cash reserves deliberately. It is very important for you to build this cash reserves for handling during the time of these crises. What does your 90-day operating cost look like? What does your 120-day operating cost look like? Can I build a buffer for these?
Mm.
So set these timelines, that what is it that which is critical for you, keeping in line with your credit facilities. You have to ensure that about 90 to 120 days I can survive without a single revenue. Can I survive this?
That's right.
90 to 122 period. So that's what you build these cash reserves for.
Mm.
And with these current context and current crisis scenarios happening often, it is very, very important that you build this particular cash reserve and keep it aside, do not utilize it, or at least keep it in liquidable context. That is, you should be able to liquidate it quickly. Not in terms of, let's say, buying a land, buying a property. They're not immediately liquidable. So don't put it in those kind of reserves.
Okay.
Use it in a liquidable fashion.
Okay.
Third, do these red chair exercises, these simulations which we have spoken about.
Mm-hmm.
What happens if I don't get that income? What happens if I don't have that supplier no longer supplying to me? What happens when I don't have these facilities? What do I do?
Mm.
What happens when this leader is not available in the chair for whatever reason? So these are the kind of things that you have to really simulate, go through that in real time. Don't just do a tabletop exercise, have a brainstorming and say, okay, probably these go wrong. Actually, as I said, have that particular, you might still have that customer, but use that entire to build your cash reserve for a 30-day or a 60-day.
Mm-hmm.
Don't utilize a single penny from that customer. You have that supplier as a backup for building your reserve, but don't use that supplier. Use an alternate supplier to do your everyday task for 30 days. Understand what are those challenges you will get, but since you still have your primary and you're having that raw reserve built, so you can always utilize it the minute there is some quality issue or there is some
urgent.
logistics issue or whatever, that you don't get the material done. So those actual real time scenarios, building it and working on it is when you would really know, and every employee in the organization would be going through with you this particular situation. So from the bottom of the organization would be going through, so they know what to do. So when the real situation happens, you don't have to train or educate or coach them suddenly. They've gone through with you, so they would immediately start knowing what to do and how to do, and there will be no paralysis in the organization if you have that real time scenarios. So I think these are the things that you will have to use and build when you are in the right
Wow. That
context.
was very, very insightful. Thank you so much, Sanmati. Because
Thank you.
I think for today, this is what it's going to be. And just for our audience, what really stands out from our conversation today? Financial resilience is not about how much cash you have, it's all about how your business is structured to respond when conditions change. The business that continues to stay strong are not the ones reacting in the moment, but the ones that build capability well before this disruption arrived. And that brings us back to the core of this series. We just don't build for agility, we build for disruptive agility. We build before the storm and we lead for the long term. If you haven't, and it's for my audience, if you haven't watched episode one, I would go back and watch it. This series is designed to build insight one layer at a time. In our next episode, we move into another critical dimension of resilience, the people side of business. What leadership looks like when organizations go through pressure, change, and uncertainty. Thank you once again, Sharmaji. Really appreciate your insights. It was wonderful to know and understand the basics. Uh, and we will definitely see each other next week. Yeah.
Definitely.
Thank you.
Thank you.
So, signing off now, this is Insight with Farzana Muhammad, uncut conversation that matters. Thank you for listening, and I'll see you all in the next episode, and I'll see you in the next week back here again. Thank you very much.
Thank you.